The case for raising the federal funds rate. The near zero federal funds rate has held back America's economic recovery. I'm Gopalan Ramachandran, and my email is upturnmanifesto@gmail.com. Thank you for your time. May I restate what I had said on December 15, 2015? The near zero federal funds rate has held back America's economic recovery. And here's the proof. The policies and the actions of the Federal Reserve have taken far too long to close the output gap. Realized or actual GDP has lagged potential GDP. America's economy has been performing below potential, and annual median income has yet to recover. Before the economic crisis, households earned above $57,000. Now, it's less than $54,000. And Paul Krugman says it doesn't feel like prosperity. He's right. And the Pew Research Center says the middle class is shrinking, and I think it's indeed shrinking. The Federal Open Market Committee, the FOMC, should vote to raise the federal funds rate by 25 basis points at its meeting today and tomorrow. A target federal funds rate between 1% and 1.25% will haul the economy forward and upward. What is the target funds rate now? It's between 0.25% and 0.5%, and it's been so since December 17, 2015. What should the target federal funds rate be? It should be between 1% and 1.25%, and the sooner the better. The summer meetings of the FOMC are on June 14 and 15 and July 26 and 27. Thereafterwards, it would be fall and autumn. And why am I focusing on summer? That's because Ms. Janet Yellen, the chair, the Fed chair, has said that a summer rate hike is not off the table. On the table then, says the Fed chair, Ms. Janet Yellen. The near zero federal funds rate, that's between 0 and 0.25%, has held the economy back between 2008 and 2015. It continues to hold the economy back now, and this is wholly explicable. Consider Dr. Harry Markowitz's capital market line and the now famous efficient frontier. And this is where we need to look at the significance of the risk-free rate RF. The Markowitz efficient frontier is an arc, and we can't work with nonlinear things. But RF makes life great. RF determines the position and the composition of the market portfolio M. It determines the risk-return characteristics of the market portfolio M. That's a very important finding in empirical finance, and the linearity, the linear relationship between risk and return has been proved. RF is a determinant of the risk premium of all other assets because it determines the line, the capital market line that runs tangent to Markowitz's efficient frontier. The federal funds rate is a proxy for the risk-free rate. Investors invest in government securities and or hold deposits in high-quality banks because they need to preserve some part of their investment and protect it from risk. The remainder is then invested in risky assets or the risky market portfolio. The risk-free rate is usually related to the current interest rate of, say, the 1-month US Treasury bill. The 1-month US Treasury bill closely tracks the US federal funds rate. What this means is the federal funds rate determines the composition, the position, and the characteristics of the market portfolio. M, the market portfolio, represents the point on the efficient frontier which maximizes the return per unit of risk. M's position is determined by the federal funds rate. And that's very important. Let me state this again. The position of the market portfolio on the efficient frontier is determined by the federal funds rate. Therefore, the federal funds rate shapes the economy's risk-return characteristics. It also determines the economy's risk preference and risk aversion. Let's work with this graph now. When the risk-free rate of return is lowered, something important happens. The line that runs tangent to the efficient frontier rises in slope. Capital market line 1 had a lower slope, and now because of the lowering of the RF, the capital market line 2 has a higher slope. And the market portfolio shifts down and to the left. Let's work with this all over again now. Because of the point of tangency being lower, M2 is now to our left and a bit lower than M1. As a consequence, the expected return on the market portfolio is lower, and also the risk. The risk of the new market portfolio is lower than that of the old market portfolio. So let's see the consequences here. M1 is the old market portfolio, M2 is the new market portfolio. And when the federal funds rate was cut from 5.25% on September 18, 2007 to 0.25% on December 16, 2008, something significant happened. The market portfolio slid to the left and downward too. As a consequence, the Feds have favored, pampered low-risk assets. Let's look at this now. The expected return on the new market portfolio is lower than the expected return on the old market portfolio. When investors are happy with the lower rate of return, they pay more for assets. Therefore, the lower expected return on the new market portfolio pushes up prices of less risky assets. That's very important. Moreover, the new market portfolio has a lower risk, and this is a bonanza. The lowering of the return pushes up prices. The reduction in risk further enhances the prices. Therefore, it would be safe and true to say that the US Federal Reserve has been pampering low-risk assets by holding their prices up. But there's an adverse effect elsewhere. The lowering of the RF raises the risk premium on risky assets. Because the slope of the new capital market line is steeper than the old market line, asset portfolios to the right of M2 are unfavorably affected. Their riskiness rises. Let me state this a couple of times. Assets to the right of M2 rise in the riskiness, and obviously all assets to the right of M1 rise in risk too. This is a twofold effect. As a consequence, the compensatory return required per unit of risk rises in both cases. Therefore, it causes a rising aversion to high-risk assets. The new capital market line raises risk, and that's very important. As a consequence, the compensatory return required per unit of risk rises, and risky economic activities that involve specialization and innovation become unattractive. The US Federal Reserve has been punishing high-risk assets and high-risk economic activities. This is exactly what the US Federal Reserve has done since 2008. As a consequence, one part of the monetary actions of the US Federal Reserve System has caused the contraction of risk of low risk assets. On the other hand, another part has caused the exacerbation of risk of high risk assets. The monetary actions of the US Federal Reserve System have hurt incomes, investments, specialization, and innovation. What this means is there has been a risk sensitive impact, and the US Federal Reserve System has to keep in mind that this risk sensitive impact has to be altered for the better, and it can't be postponed any longer. Let's consider infrastructure. Low interest rates have not triggered the rebuilding or replacement of depreciating infrastructure. Low interest rates have not triggered the building of new infrastructure. The rise in the risk premium explains why the pause button on funding infrastructure has been pressed. America isn't taking care of itself. And what Laddie Summers, the former Treasury Secretary, says is this: at this moment, the share of public investment in GDP after adjusting for depreciation, which means its net share, is zero. So America is hurting its jobs, America is hurting specialization, America is hurting innovation, and America is hurting itself in the context of infrastructure too. And this is the right time for the FOMC to set right or reset the course. It should raise the Fed funds rate at its meeting today and tomorrow, because there is some hope, there's some optimism that US GDP is looking up. GDP now says that the second quarter forecast is up. It's now 2.5%. The labor market dampness should not deter the FOMC. The labor market will heal itself once the risk premium on specialization and innovation is brought down. So the Feds should take the data from GDP now very seriously and should vote for raising the US Fed funds rate in its meeting today and tomorrow. And this is the right time to do. So here's what the FOMC should do. The FOMC should vote to raise the Fed funds rate by at least 25 basis points when it meets today and tomorrow. Why? The near zero Fed funds rate has led to an unaffordable rise in the risk premium in the economy. This has hurt young and risky firms. This has hurt households that depend on specialized but risky skills to earn their incomes. This has hurt real median household income. This has more seriously hurt investment in infrastructure. Thank you for your time. I hope to see the Fed funds rate go up again. Write back upturnmanifesto@gmail.com. Thank you for your time again.